What's involved in selling your IT services company? Hi, my name's Rory McCaw. Welcome to Self-Made Strategy. I'm a serial tech entrepreneur, really a serial entrepreneur, but I sold my tech business that I started in 2001 in 2018. So 17 years, it was not a get-rich-quick scheme. A lot of hard work and countless hours poured into that, and a lot of things forsaken or given up in terms of choices that I made in order to grow that business to a point where it was saleable and I was able to exit. This channel is for IT service founders that are in a similar position. You're growing your business and you're looking for tips and tricks on how to do that more effectively, maybe faster, more efficiently, and you are looking to exit at some point in the future. So what goes into selling your business? There are a lot of different aspects to this, and I hope to cover the majority of them in this video. I've got a short video out that talks about some of these, but let's start with planning, and I'll use my story as the example. So I sold my business in 2018, but I started planning for the sale in 2013, so 5 years prior. Now, why so far in advance? Well, one of the reasons is in Canada, the tax laws that are in place around organizational changes usually have some type of burn-in period. So they have to have occurred a certain amount of time before a transaction occurs so that you're prevented from making rapid changes at the last minute to avoid paying tax. So I started the planning process, and when I started, I personally was the owner of my Canadian business and my US business, both operating under virtually the same name, certainly the same brand. So from a customer standpoint, they saw no difference when they were working with us. But if you were in the US, we billed you through our US entity. And if you were in Canada, we billed you through our Canadian entity. And then from an employment standpoint, we had US employees, obviously under the US company umbrella, and Canadian employees under the Canadian umbrella. So when I reorged, what my advisors, who were the advisors? So I went to a fairly well-known, maybe not Big Four, but Big Six accounting firm in Canada. And I used the accounting firm to help me create or determine what the value of the businesses were at that point in time. So they created what was known as an adjusted cost base for my shares in the businesses. And then they did a bit of a share swap, and I won't get into the intricacies of that in this video, but they basically took my common shares that I owned of both companies and swapped them out for preferred shares, and then baked in or created a value, came up with a value for those companies at that time, so that any value from that point forward would be attributed to the new structure, and then deferred my payment of any gains on that derived value at the time into the future when a transaction or a sale occurred. So what ended up happening is they created in Canada for me 2 new entities. The first was a family trust, and they called it a discretionary family trust with beneficiaries. And the beneficiaries were primarily family members. So certainly people, my wife, my kids, and my immediate family, but then also my parents and my in-laws as additional beneficiaries, and any companies that I was an owner of would fall into that. And if I were to have kids in the future, they would be a part of those beneficiaries, but that was not in the plans and has not happened at this point. So the family trust ended up owning the Canadian company. And the benefit of that in Canada, with multiple beneficiaries and a discretionary trust, is every year the CRA, Canada Revenue Agency, increases what they call the Canadian Small Business Capital Gains Exemption. So if you meet the criteria for selling a Canadian business, and that business is purchased as a share sale, so they purchase the entire corporation and everything to do with it, which is how I transacted my sale, then you're entitled to whatever the allotment is at the time for this Canada Small Business Gains, Capital Gains Exemption. Now with a family trust, because the trust owned the business, the trust receives the funds from the sale of the Canadian company, and then the trust, if there were 5 beneficiaries, gets to use each one of the 5. So let's say that the small business exemption is $1 million and you have 5 beneficiaries, that's $5 million. So if you sold your Canadian business for $5 million, each one of the beneficiaries could be distributed $1 million, and it would be effectively tax-free. So it is a phenomenal way to achieve a nice little windfall, all within the legalities of the Canadian tax system. Now, the same is not true for a US organization. And part of the reason that they didn't want they being my accounting firm, didn't want my Canadian business to own my US business is so that the Canadian business met the requirements for that small business capital gains exemption. So instead, they said, your US entity, again, shouldn't be owned by me personally, but we'll create a holding company in Canada, CCPC, Canadian Controlled Private Corporation, and that'll be a holding company, and the holding company will then own your US entity. So when I sold my 2 businesses, the money from my Canadian business sale went to my family trust. The money from my US company went to my holding company. And then at the same time, I was leasing office space for the business. This was pre-COVID, and we were still typically going into the office. And I was leasing office space in Toronto, and that space was costing me, I don't know, $60,000 to $80,000 a year. And an office building came up in the area that was way larger than we needed. It was 8,500 square feet, and we were in a maybe 1,800 square foot office at the time in a high rise. But when I looked at interest rates at the time and the annual cost with a mortgage on the building based upon the price of the building, I would have been paying less than $100,000 a year, so $40,000, $30,000 to $40,000 more than I was paying now for rent, but I'd be paying myself. So we created a real estate company, and the real estate company owned the commercial property, and my operating company in Canada leased space from my real estate company. And the benefit there was when I sold my 2 tech companies, Canadian and US companies, I held on to the real estate company. The purchaser of my tech companies was a US-based company out of Denver. They had no interest in buying a company that owned real estate in Toronto. That was not part of their mandate for growth or part of the acquisition. But I was able to structure a lease as part of that transaction with the purchase that kept my old company, my operating company, the IT services company in Canada that I was selling, in the building that I owned for a couple of years. And that's something that I would highly recommend. Although office space has been dismal for the COVID period, certainly wasn't a winning investment there, but it has appreciated over time, and it allowed you to keep an asset that you can borrow against, because as you're probably familiar, if you're a tech entrepreneur and you've ever gone to your bank, one of the things that banks want is they want some level of collateral when you go to borrow money from them. And as an IT services company, you have maybe some depreciating capital in terms of computers and equipment, but you don't have any real estate, you don't have any hard assets. You probably, hopefully, you're not running your cars through your business. And if you have cars, you're probably leasing the cars so that you get a better tax write-off on those. So you typically don't have a lot of hard assets in the business. And so it makes it hard to borrow from traditional lenders. Doesn't mean it's impossible to borrow, just means that when you do borrow, the interest rates that you pay are typically going to be a little higher than normal when you can back up and provide collateral for what it is you're borrowing against. So the planning process was critical in helping to optimize how much money I was able to actually take out of the business, take away after taxes once the sales occurred. In fact, because of the Canadian company being owned by the family trust, paid little to no taxes in Canada on the sale. Now, that's going to upset a bunch of people who believe that the rich should pay more taxes, and you're entitled to that opinion. But just remember, I've been paying employees who are paying taxes in Canada. I was paying corporate tax every year based on Canadian corporate tax rates. I did my fair share of tax payments over the years, and on the sale I did certainly pay taxes, and then I pay taxes now on all of the income that's derived from the money from the sale that I invest in various different things, and I pay taxes through my real estate company. In the US, the sale funds went to my holding company, and the holding company then had to pay taxes on those. But my tax accountants played a very important role in that transaction and helped me to leverage some tax laws that I wasn't aware of at the time, that again helped me to reduce my tax exposure even on the US sale. Now, a lot of those rules have been unwound or changed at this point in time. But at the time, they were extremely beneficial from a transfer of ownership and exit perspective. So that's an important aspect, is the pre-planning. Another important aspect is figuring out the right M&A firm to use. And I was lucky enough to find an M&A firm that focused on Microsoft partners, which we were. So we were a fairly well-known, recognized Microsoft partner in a very specific niche of the Microsoft ecosystem. So we weren't a generalized partner that did everything, but we were very focused in what was called Microsoft System Center and evolved into Azure Cloud Automation and effectively the monitoring, management, and automation of workloads in that Microsoft kind of ecosphere, if you will, or ecosystem. And we attended a number of Microsoft conferences and were well known throughout North America as an expert in those technologies. So finding the right M&A firm and getting your ducks aligned, having everything prepared, the documents that they're going to require for your data room, knowing how to pitch your company, where you differentiate yourself in the marketplace, and even having a list of potential buyers. Now, potential buyer list that I came up with did not include, in the end, the company that bought my organization, but you want to think a little outside the box, and certainly outside of your local region. I was very specific in hiring a US M&A firm for two reasons. First, they had a much broader background, and they were involved in many more transactions than even some of the big accounting firms in Canada, and their scope was more US focused. And I really wanted to transact with a business in the US and wanted a US firm to buy us for the simple reason that the US dollar was worth 35% more than the Canadian dollar, and I wanted that uplift on the proceeds from the sale. So why would I sell to a Canadian firm and take a 35% haircut when I could get 35% more selling to a US firm? So it just made sense to look for a US buyer. And US buyers typically, as well as US customers, make decisions faster, and they're more they're just faster, I think, in my experience, to make decisions, and more interested in growing by acquisition and less conservative than Canadian firms. A lot of Canadian firms, again, from my experience, they sit on the fence, they sit on their hands, they wait to see what happens in other countries, particularly the US in the past, and they delay things, and that just slows down the process. So the M&A firm choice was very, very important. All told, with my US attorneys, Canadian attorneys, the tax planning back in 2013, my family trust set up, the holding company set up, the real estate company set up, the taxes on the sale really of the US company, all told, my business, it probably cost me close, I don't have the exact number, but I'm going to say between 1.2 and 1.8 million dollars to sell my business in terms of the costs of those professionals, but also the taxes that were involved. And I think that was the deal of a lifetime, because the taxes could have been 30 to 50% based on our Canadian tax rates, or 25% with the capital gains inclusion rate at the time. But that Canadian small business capital gains exemption went a long way to putting a lot more money into my pocket in the end, or my pocket and my beneficiaries' pockets. And those people kept the money. So, I mean, I didn't get the money back. That money was theirs. There was no way legally for me to take the money back after it was distributed to them, but I helped them invest it and grow that, and just help support them as family members. So those are some of the lessons that I learned for transacting a sale of my business. I hope they're helpful to you. I hope you're enjoying the channel. If you are, leave me a like, leave me a comment, please subscribe. And if there's anything you'd like me to cover or talk about, send me a comment or a DM, and I'd be happy to talk about that if I have the experience to be able to share something of value to you and help you grow your business faster. Good luck.